Hey everybody, Don Fishback, and what a week it's been. I go to Chicago for a few days. I'm out of the office at the Chicago Board Options Exchange, and look what happens. Last time I was with you, I think we were talking about some big volatility spikes and how you got the big volatility spike in 1929, you got one in 1987 and 2008, and the 1987 one, I talked about how it was a transitional period, or you had just changes, big changes in the way we operated the stock exchanges, and even in life, where in 29 we got FDIC, Glass-Steagall, and the SEC, the New Deal, and in 2008 we got Dodd-Frank, and the way we banks evaluated home ownership or home loans. And in 1987, we got circuit breakers. And I've been in this business since 1987, actually since 1984. In 1987, I'd been in it for 3 years. And one of the things that we did not have in 87 was circuit breakers. Well, we have them now. And I remembered in 1997, we had a day where we hit the circuit breakers twice. Well, this week we've hit the circuit breakers 3 times already. We hit the circuit breakers on the downside on Monday, hit the circuit breakers on the downside on Thursday, and then we hit the circuit breakers this morning on the upside. So that will tell you just how crazy this market has been. I've got some notes here and I don't want to skip anything. So the difference I wanted to point out about 1987 and now in 2008 and now is that in 1987, the crash was isolated mostly to investors, individual investors and professional investors. So back then, you did not have not a lot of people had their assets tied up in stocks, bottom line, because most people have their assets tied up in their home. That's most people. There's lots of people do have money tied up in stocks, but that's typically a longer term investment. So it did not lead to any kind of catastrophe economically or anything like that. 2008 was very different because back then, not only did you have the big crash in stocks, you had the big crash in housing, and that's where most people have their assets. And not only that, the home ownership rate in 2007 was the highest it's ever been. It almost got to 70%, which was really high home ownership rate. So when that fell, you had the net wealth of 70% of the Americans out there lost wealth, and that created a huge decline in wealth, which led to, oh my gosh, I've got to spend. It led to that hoarding that I've talked about, and it led to a crush of joblessness. This one is different still. This one's caused by a panic, and so what's going to happen, what's going to determine this is the length of the panic. So I do have some good news. The data, we're starting to see some improvements in the reliability of the data, and that's been probably the biggest hang up in all of this, is that the data just hasn't been reliable. What's coming out of China, you can't trust it. What's coming out of Iran, we don't know anything about that. The accounts are really unreliable. So people have had to react with, I better be safe. I'd rather be safe than sorry. And so that leads to the panic type thing, where you get I better have enough toilet paper because I'd rather be safe than sorry. It's also a little retail therapy going on there too. So anyway, what happens is you just have the data is ambiguous, and that leads us to prospect theory. And for anybody that's familiar with prospect theory, one of the big components is this notion called ambiguity aversion. And when you get a lot of ambiguity, you get the big sell-off. And this is a chart of the big sell-off that we've seen right here. And we are right here. And I just happened to go back to a period. This is September 2017. So basically, this is September 2017. We had the big rally. There's the volatility explosion. And then we had another rally. And then this was when the Fed started mistakenly raising rates and had to reverse itself. And then we had another big rally. And then you've had this big collapse. And so I want to bring up some points right here. We have, not to pitch anything, but we have a service that we call 3 Pillars to Wealth, and it's built on 3 pillars. And this is when I think I've talked about this in an earlier video, that if you look at Marty Zweig's book, Winning on Wall Street, Terry, give me a copy of that book, would you? It's right there in the bookshelf. Yeah, this is just happened to have one. Thank you. Right. Here's Marty Zweig's Winning on Wall Street. I even have a little business card right here that goes right to the page. And there is the table right there on page 184. And it talks about, it lists every bear market since 1919. And it talks about the extreme deflation, the very high PE ratio, or an inverted yield curve, and then it identifies the decline in the market. And the very high PE ratio, we've replaced that with the sentiment because, well, for a variety of reasons, which we actually get into in the course. But anyway, the yield curve, that is still bullish. The sentiment, that thing actually turned bearish on March 4th. So it's been bearish for, what is today, the 13th? So a little over a week. And then the deflation, which I know I've talked about because Terry and I've talked about commodities. The deflation turned bearish last Friday when the OPEC meeting broke down. And so this is when, this is the market this is over the last 3 months. And you can see the moves don't really look that big when compared to what's happened lately because we're down here. And so the 3 pillars, it's designed to, you're never going to pick the top, right? But the market started to drop, rallied a little bit, the sentiment turned bearish, and then the bottom, so the bearish, and then right here is another point. This is where the deflation turned bearish, and then the bottom fell out. But this is the one that got, if we get any one of those 3, one out of the 3, then we want to get out. So that's that. And here, I've got the deflation. This is where it is right now. And if you'll recall in earlier videos, I was talking about if it gets down here, it's catastrophically bad. And basically what happened is the breakdown in the OPEC Plus, which is OPEC plus Russia. The Saudis and the Russians had a sort of a pact that they were going to limit their production, and that pact broke. And one of the reasons the pact broke is because China wasn't buying any oil, so the prices are going down. So how do you make up the revenue that you're getting, that you're missing because the volume is down? Well, their intention was to just produce as much as they could at 30 and make it up in volume. I don't know if that makes any sense, but now you have a price war between Russia and Saudi Arabia, and that caused this thing to fall out of bed. So that's a big problem, because what this leads to, we talked about this in the hoarding and the deflationary spiral, is you have the airlines that they're parked, you have the cruise ships, they're parked, you have shipping volumes. I know we talked about Charleston, shipping volumes down, and I think last Friday I mentioned that the Chinese shipping volume was down 80%. They're only shipping 20% of what they normally do. So all that fuel gets left behind. That means there's not as much demand for oil drilling. That means there's not as much demand for steel. You have so you might get the steel workers laid off, you might get the energy workers laid off, the airline workers laid off, the hotel workers laid off. People are being told to stay, the social social distancing and self-quarantine. Right. So social distancing and self-quarantine. So when you get all that, the restaurants, and so you get this, you could get this wave of unemployment. Now the good news is I saw something from National Federation of Independent Businesses, which is small business. I'm one of those people too, is the sales have basically fallen off a cliff, right? But we're nervous. This independent businesses, they're nervous. There's a wide little bit of fear out there, but nobody's doing anything because our hope is that this will be over soon, and as soon as it's over, it'll be right back. And so nobody wants to let anybody go because we're expecting a pent-up demand to come back, especially with China getting back to business, Korea's getting back to business. So hopefully this is just temporary. But I did want to point out that this is a sign that the economic demand, global economic demand, is very, very low. And that brings up the slow economy creates that big downdraft. And when you get that big downdraft, you get the pop in volatility. And here we are. This is the 10-day historical volatility of the S&P index. And the reason it's not the S&P 500 is because the S&P 500 only goes back to the 1950s. Prior to that, it's a reconstructed index using stocks that were a segment of the stocks that would comprise the S&P. So anyway, here we are at 80 right here, and then here we are and this is going all the way back to 1928. So we're going way back, and this is the 2008. This is the financial crisis right here, and you can see it got above that. And then here's the crash in 1987. That's the one that was stupid right there. I mean, that was a crazy day. I'll never forget. And I've got my Mac somewhere in my office here, the old Mac from back then. I had a little Macintosh that was a year old, so 1986 Macintosh. And then I had a quote screen on my desk, and it's those ugly green monitors, right? That's just flashing numbers, and I'm hollering at my wife, "Robin, the Dow's down 100," and that was when it was only 1,700, so that's like 1,000 points. "Robin, it's down 200." It's like, and then it's down 3 and 4, and I mean, I'm just hollering this stuff out. And I remember watching the FNN, which I think some of the people with Financial News Network are still at CNBC, but I remember that vividly. And then we get the granddaddy of them all, and you can see this was a spike and this was a spike. Well, here's a spike here in 29 right there, almost rivaled the 87 crash, but then you got bing, 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 and you got them repeatedly right there. So this was easily the most volatile period in the market. So anyway, that gives you a little bit of history. Where are we currently? And this is a really interesting indicator from our odds online. It's called the Volatility Comb. And what it does is it looks back at various historical volatilities. So this is the 1 month right here, 2 months, 3 months, 4 months, and so on. So I'm going to take the 1 month historical volatility, and I'm going to go back all historical data. So it goes back to 1998. So I'm going to take the lowest 1 month historical volatility and plot it there. And so in that entire 22-year history, that's the lowest the 1 month historical volatility got. That's the highest it got, this purple line right up here. So where is the current implied volatility of the options that are 10% out of the money? So these are the options. If SPY is at 250, these would be the 225 puts. Where is the implied volatility? And it's right there. So if I'm thinking about selling them, that's really, they're extremely high compared to history. And then we do it for 2 months and 3 months. So this gives you an idea, just an instantaneous idea of where volatility is relative to, where implied volatility is relative to historical volatility. And if implied volatility is the prices, historical volatility is the movement of the stock, you can get an idea of where the option prices are relative to the movement in the stock. So real high. And so And that's what caused it, that big drop right there. This is another really interesting chart. This is what I call the odds volatility map. And what this shows, this is the change in the price of the underlying. So this is the change in the price of the S&P 500. And this is the point change in VIX. And you can see when when the market dropped about 10%, VIX rose 22 points, went from 53 to 75. And so it's actually following the path. It's a pretty predictable path. You can see right here. Very high correlation. So anyway, this is what happened yesterday was pretty typical. And this is the one from earlier in the week, and then there's another one from earlier in the week and another one from earlier in the week. So the market is actually this week behaving pretty close to what you would expect. Not too different, at least in terms of the options. Okay, so when Terry and I did a video maybe 3 or 4 weeks ago, I said I wanted to be a buyer of calls. And you're going, oh my gosh, that could have been the absolute worst thing ever. I mean, why would a guy buy calls and then the market just gets absolutely trashed? Why would I be glad? Why would I be glad that I advocated buying calls when the market got hammered? I have an answer to that question. Because when you say, why buy calls, wouldn't I have been a whole lot better off if I said, man, whatever you do, buy a protective put. That's the most important thing you could do right now. Buy a put to protect yourself. Well, what's a protective put look like? You use it because you think it's going to drop eventually, but you think it's going to go up eventually, but you think a drop is possible, right? So you buy a protective put. I still want to own the stock, but I think it's going to go down. It might go down first. The drop is possible, and the drop could be large, and the decline could happen real soon. But that's exactly what happened, isn't it? You think the market might go up, but the drop is possible, and it could be large, and it could happen soon. And that's what happened. Well, this is a chart of what a protective put looks like. So you buy the stock, and if the stock goes up, you make money. And if it goes down, once the stock reaches the strike price, then the put starts making up the losses. So for every dollar the stock goes down, the put makes money. So it looks just like that. That's what a protective put looks like. So your maximum risk is the stock price plus the option price minus the strike price. Now your maximum profit, it's unlimited, you can see that. And your break-even price at expiration is the stock price plus the option price. So whatever the stock price is plus the option price, that's going to be this point right there. So you have to buy the stock. So pay for the stock, whatever it's. So if you're buying 100 shares of Microsoft at 170, well, where is it Microsoft now? 150 maybe?
I think 150.
150. So 100 shares, $15,000. It's going to cost you $15,000 for the stock plus the cost of the option. So what's that?
143.
143. Okay, man, that's brutal. That is brutal. Okay, so you're going to have to come up with $15,000, $16,000 to put a protective put on in Microsoft. So that's the protective put. What's the call look like? Oh my gosh, this didn't change, did it? This is what a call option looks like. Now this time the maximum, and by the way, the maximum risk is the amount paid to buy the option. So in this case, you're only risking, you might be able to put that option on for, well, I know it's going to be less than $15,000, right? It might be $800 or $1,000. So you're getting the same profit potential, and now the break even is the strike price plus the option price. So the break even is just about, it's going to be about the same, but you're paying a whole lot less. So you're getting, there's a protective put, there's the call. They're no different. And that's actually a term we call equivalent positions. So that's the reason why I wanted to have something that was like a protective put. But instead of buying the stock and putting all that money in the stock, I said, buy the call and put the money in a money market. So they are the same, and you use the calls to replace the stock, and that actually is less risk. And then you can actually get just about the same thing. So this is a graph of the S&P 500. The red line is the S&P 500 Total Return Index. And the blue line is what you would have earned if you took the same amount of money that you would use to buy the S&P, but instead you put 96% of it in a money market and you put 4% in the option. So let's say you had $20,000, right? So then you would take 4% of that, which is what, 800 bucks? You take $800 and you take the rest of it, put it in a money market, earn interest on that, although the interest is really low right now, but back then it wasn't. So anyway, you put that, and then you would take the $800 and buy calls with it, and these are specially selected equity calls, and you can see you actually keep up with the market quite a bit, but when you get these big downdrafts like you got in 2008, you lose, but you don't lose as much. And then this is what happened this week right here. This thing just got absolutely torched. So if you were in the S&P 500, you'd have gone from 85,000 down to 60,000. And here you would have gone from about 86,000 down to 80,000. So if you do options right, if you buy calls correctly, you can actually reduce your risk. You can get almost the same bang for the buck, but not get absolutely torched when the market goes into a bear market. So that's the reason why, this is the reason why I said now's the time to be focusing on buying calls as a replacement for stock, because the risk was high. The coronavirus was starting to spread. We were seeing some signs of deflation. We had the commodity prices that were problematic. So that's the reason why I wanted to buy calls. So now the next question is like, okay, that was last month. Now what? Well, what I'm going to be talking to you about, I'm actually in one of these that expires later today. It's right on the borderline of being profitable and unprofitable. We'll see how it ends. But it's called a put credit spread. And you can see it's got a bias to where you want it to be, you don't want it to go down. This is a lot like selling insurance, and we're going to talk about that in a separate video if I can get it up either later today or first thing next week. But I like the idea of credit spreads, because what you're doing is you're selling expensive option premium. It's a lot like going into the insurance business. And anyway, there are limited risk ways to capture high volatility. And I've got a loud siren coming, so I'm going to sign off, everybody. I want to thank you for watching. Be sure to let us know any comments. Be sure to let us know if you have any questions or anything like that. Visit our website, subscribe, and all of that stuff. And please interact with us. We love getting your comments and your feedback. Thanks for watching.